Honeywell Technologies just beat consensus.
Yeah, management explicitly called out Q2 outperformance.
Right, so let's hit the headline numbers immediately. They reported consolidated sales of $9.7 billion. That is up 4% organically.
And if you look at the standalone Honeywell Technologies business, sales came in at $5.2 billion, also up 4% organically.
Looking at the bottom line, they reported an adjusted EPS of $1.95.
Which is a solid 10% jump year over year.
Huge. Plus, management raised their full-year adjusted EPS guidance midpoint to $8.20. That would be up 27% year over year.
And full-year sales guidance is now set between $19.8 billion and $20 billion.
So regarding the stock reaction, we don't have the immediate post-earnings ticker tape in front of us, but you really have to keep in mind the company executed a 1-for-2 reverse stock split. That was effective June 29th.
Right, that fundamentally shifts the share structure on your screens.
Exactly. It automatically doubles the per-share metrics, so you have to factor that in when analyzing the price action and, historical comparisons. So the mission for this deep dive into the source material is to basically unpack this Q2 2026 report.
Right.
We need to decode this massive set of structural changes.
Yeah, the spinoffs and divestitures.
Right. And analyze if this highly publicized pivot to become a leading pure-play automation company is actually working.
Because the transition happening here is, well, it's incredibly complex. They are essentially attempting to rewrite their corporate DNA in real time.
Right in front of the public markets.
Exactly. You are looking at an income statement that is straddling two entirely different eras of the company.
Yeah, we have to address the accounting noise on this income statement before we can even evaluate the actual business. Because if you pull up the raw JAP numbers for this quarter, the earnings report shows an EPS of $17.83.
Which is just wild on paper.
Right. We just noted the adjusted EPS went all in 95. That gap is staggering. Seeing a $17.83 EPS on a stock that usually earns, a couple of bucks a quarter requires a lot of context.
Yeah, so a full $15.78 per share of that reported gain stems entirely from the deconsolidation of Quantinuum.
Their quantum computing venture.
Right. They basically shifted how they account for their ownership stake on the balance sheet. When you change the accounting treatment of a subsidiary, like moving it from a fully consolidated entity to an equity method investment, you are required to revalue your retained stake at fair market value.
And quantum computing valuations are just astronomical right now.
Absolutely. So that revaluation triggered a massive one-time non-cash accounting gain.
So it aggressively pads the balance sheet, but it does not mean Honeywell suddenly sold $15 a share worth of extra automation equipment.
No, not at all. It's purely an accounting mechanism.
And it's not the only structural change muddying the waters here. We also have the June 29th spinoff of the Aerospace Technologies segment.
Right, which is now an independent, publicly traded entity under the ticker HONA.
So from Q3 onward, aerospace is completely out of the picture. But because this split happened literally on the last days of Q2...
the consolidated Q2 numbers still include that aerospace performance.
Right. That mid-year cutoff is what makes this quarter so difficult to parse at first glance.
You're essentially looking at a hybrid income statement. The revenue and expenses from building jet engines and avionics are still mixed in with the industrial automation figures.
Even though that business is now entirely separate. So here's how you should frame this. Reading this quarter's earnings report is like evaluating your ongoing household budget in the exact same month you decided to sell your guest house, which is the aerospace spinoff.
I like that analogy.
Thanks. And on top of that, you also happen to find a winning lottery ticket stuffed in the couch cushions. That's the Quantinuum accounting game.
Right, so it makes your net worth look incredible for exactly 1 month.
Exactly. But it tells you absolutely nothing about whether or not you can afford your grocery bill next week. You have to ignore that noise and look at the ongoing operating budget.
The signal we need to focus on is that $1.95 adjusted EPS and the metrics for the standalone Honeywell Technologies business.
Then the standout data point there is the 16% jump in standalone orders.
Yeah, which has built up a $20 billion backlog. Backlog has promised future revenue, and carrying $20 billion into the second half of the year provides management with some really significant visibility.
Okay, wait, let's dig into that backlog for a second.
All right.
Because in an industrial context, a $20 billion backlog sounds like a fortress. But how firm are those orders? Like if the macro environment cools, are we looking at cancelable contracts or is this locked-in revenue?
So the majority of industrial automation and building automation contracts are highly structured with severe penalties for cancellation.
They aren't just buying off-the-shelf software.
Exactly. These are deeply integrated capital expenditure projects. When a commercial developer orders a comprehensive building management system, pulling out halfway through construction is often more expensive than just finishing the project.
Oh, wow. So that stickiness is what makes the $20 billion figure a reliable runway.
Yeah, it really does.
So with aerospace officially out of the picture, we need to look at what is carrying the weight for this new pure play automation entity. Looking at the segment breakdowns, it seems like building automation is doing the heavy lifting.
It absolutely is. Sales hit $2.0 billion for the quarter.
That's up 10% on a reported basis, right? And up 9% organically.
Yep. But the top line growth is solid. The profitability is the real story here. Segment margins in building automation expanded by a massive 90 basis points, reaching 27.1%.
Which is huge.
Yeah, in the world of industrial hardware and software, expanding your margins by nearly a full percentage point in a single quarter requires serious operational leverage.
And the sources specifically note this growth was driven by higher demand across both their products division, which was up 10% organically, and their solutions division, up 8% organically.
So they are selling both the physical hardware, the sensors, the thermostats, the security cameras, and the integrated software systems at a higher clip.
But wait, how are they managing to expand margins by 90 basis points when inflation has been basically chewing up corporate margins across the broader industrial sector?
It really comes down to pricing power. Management successfully utilized pricing actions and productivity gains to more than offset inflation.
Because building automation systems are deeply embedded into a facility's operations.
Exactly. If you are a commercial property owner, swapping out your entire HVAC and security integration layer just to save a few bucks on a competitor system is massively disruptive. It requires downtime, retraining, and usually completely new hardware.
The switching costs are astronomically high.
Exactly, which gives Honeywell the leverage to raise prices. Furthermore, modern building automation systems are increasingly tied to energy efficiency.
So if Honeywell's system costs 8% more this year, but it reduces a building's overall energy consumption by 15%.
The property owner will absorb that price hike because the return on investment is still totally positive.
That makes a lot of sense. That dynamic makes building automation the high-margin anchor for the new Honeywell.
Yeah, it operates as a margin machine, basically funding the rest of the enterprise.
But if building automation is carrying the weight, the transition to this pure play model is exposing some real friction in the other two segments. Let's look at process automation and technology, or PANT.
Right, where sales came in at $1.67 billion.
Which is a 1% organic decline. But the real issue is the margin contraction. PANT margins dropped a full 180 basis points down to 22.1%. What is driving that kind of drop?
The sources point to a decline in catalyst shipments. Catalysts are specialized materials used to accelerate chemical reactions, and they are heavily used in the refining and petrochemical industries.
This is a classic razor and blade business model, right?
Yes, exactly. The underlying processing equipment is the razor, which might have lower margins, but the consumable catalysts are the blades. They carry incredibly high margins.
So when the volume of those high-margin consumables drops, it disproportionately drags down the overall segment margin.
Yeah. The fixed costs of operating those chemical and industrial divisions remain static. So when the high-margin revenue mix shifts downward, the operating leverage works against them, causing that sharp 180 basis point contraction.
And catalyst demand is highly sensitive to the broader petrochemical cycle.
Right. If refineries are destocking inventory or slowing down utilization rates due to macro headwinds, catalyst orders are the first thing to get cut.
Now, that brings us to the third segment, industrial automation. Reported sales were down 5% to $1.5 billion.
And I know we have to adjust for prior divestitures there, which brings the organic growth to a positive 4%.
Sure, but margins are still sitting at 17.2%. That is noticeably lower than building automation's 27%.
Yeah.
I have to push back on Devakapur's entire thesis here.
Okay, go for it.
The whole justification for spinning off a highly successful, predictable segment like aerospace is to become a leading pure-play automation company. But in their very first quarter, touting this new identity, we're looking at a 180 basis point margin drop in process automation and a low margin profile in industrial automation. Doesn't this completely undermine the pure play narrative?
I mean, it is the glaring friction point of the quarter, and it is exactly where analysts will apply pressure. The thesis of a pure play company is that focus breeds efficiency.
But right now, that efficiency isn't showing up across the board.
No, it's not. However, management is actively deploying capital to engineer a fix.
Hmm.
On July 17th, they closed the acquisition of Johnson Matthey's Catalyst Technologies business.
Wait, so they bought another catalyst company to plug the leak in their own catalyst division. Does buying more of a cyclical business actually fix a cyclical demand problem, or does it just make them larger in a struggling sector?
It's a scale play. By acquiring Johnson Matthey's portfolio, they are broadening their catalyst offerings, gaining access to new proprietary technologies, and acquiring a larger customer base.
So the strategic bet is that increased scale will allow them to capture more market share.
Right, and improve their margin profile through cost synergies, even if the macro environment for petrochemicals remains soft.
It's an aggressive move to buy their way out of a weak spot. And management is certainly not backing down on their forward projections, are they?
Not at all. They issued explicit guidance expecting margin expansion acceleration in the second half of the year, driven specifically by process and industrial automation.
They are essentially telling the market that the friction we are seeing now is temporary, and these strategic acquisitions will smooth out the bumps.
Yeah, they're heavily reliant on that second half rebound. Without aerospace providing a predictable floor for earnings, the pressure to deliver on that margin expansion is immense. But they aren't just relying on organic sales growth or acquisitions to hit those targets.
They are aggressively managing the bottom line by trimming the fat. Which brings us to the divestitures.
Right.
The sources highlight the impending early August close of two major sales: Productivity Solutions and Services, or PSS, and Warehouse and Workflow Solutions, WWS.
They are shedding these lower margin businesses.
But what's really fascinating is how they are utilizing the proceeds from these sales. It shows up very clearly in the bridge to their full year 2026 EPS target.
Yeah, the EPS bridge is critical to understanding the financial engineering happening behind the scenes here. Management's revised $8.20 EPS midpoint is fueled in part by projected operational segment profit.
Which adds about 17 cents to the EPS.
Right. But there is another significant driver, a $1.13 benefit from lower second half interest expenses.
Let's look at the mechanics of that, because that $1.13 isn't coming from selling more automation software.
No, it is coming directly from the balance sheet. They are taking the cash proceeds from selling off the PSS and WWS divisions and using it to aggressively pay down their corporate debt.
I mean, in a high interest rate environment, carrying corporate debt is incredibly expensive. Every dollar of debt you retire provides a guaranteed, risk-free return in the form of avoided interest payments.
And that avoided interest expense drops straight to the bottom line. It reduces costs below the operating line, boosting net income.
So when you divide that higher net income by the newly halved share count from the reverse split, you see a dramatic boost to the EPS.
Exactly. It is a highly efficient way to manufacture earnings growth, even if top-line sales are grinding through a transition period. They are using capital allocation as a lever to protect the EPS target while the underlying industrial businesses attempt to find their footing.
It's essentially a cheat code for EPS growth during a corporate transition. You divest the low-margin units, take the cash, pay down expensive debt, and your earnings look healthier even if the core business is facing cyclical headwinds.
But they are also focusing heavily on operational costs, because when you spin off a massive division like aerospace, you are left with stranded costs.
Stranded costs being the corporate overhead, the IT infrastructure, human resources, real estate, and executive layers.
Right, the stuff that was previously supporting a sprawling conglomerate, but is now totally oversized for the remaining streamlined business.
Because if you spin off 30% of your revenue, but keep 100% of your corporate headquarters staff, those stranded costs will eat your margins alive.
Exactly. The sources note management's focus on the accelerated removal of these costs, leveraging what they call the Honeywell Accelerator operating system.
The Honeywell Accelerator is their proprietary framework for standardizing processes across the enterprise, right?
Yeah. It is designed to identify redundancies, automate back-office functions, and ruthlessly cut corporate bloat. It's how they are resizing the corporate infrastructure to match the smaller, pure-play footprint.
So by shedding the lower-margin businesses, aggressively paying down debt to reduce interest expense, and utilizing this internal operating system to eliminate stranded costs, they're building a fortress around their cash flow.
The explicit goal here is capital preservation and cash generation. They are fiercely protecting their target of generating approximately $2.0 billion in free cash flow for the year.
By shrinking the operational footprint and lowering the debt burden, they increase the conversion rate of their remaining revenue into free cash flow.
And that cash can then be used to fund further acquisitions, like the Johnson Matthey deal, or be returned to shareholders.
Okay, let's synthesize this entire report. CEO Vimal Kapoor called this quarter a historic milestone and celebrated the creation of a simplified company.
And looking strictly at the numbers we've discussed, the targeted acquisitions in the catalyst space, the divestiture of low-margin warehousing segments, the $20 billion standalone backlog, and that 90 basis point margin expansion in building automation, the data absolutely shows a leaner business that is aggressively focused on automation.
The narrative simplification is undeniable. Investors no longer have to model out commercial aviation supply chains, quantum computing burn rates, and warehouse barcode scanners all under one picker.
They are now, unequivocally, an industrial and building automation company. That clarity allows the market to value them against a much tighter peer group.
But that simplification leads to a critical question you need to ponder as an investor. Historically, the aerospace segment was the defensive armor of this conglomerate. It provided incredibly steady, predictable revenue through long-term government and commercial aviation contracts.
Yeah, it was countercyclical, meaning when industrial manufacturing slowed down, aerospace kept the earnings floor intact.
So by shedding that defensive armor and spinning out the high-growth wildcard of Quantinuum, they have cleaned up the balance sheet. But in becoming a true pure-play automation company, have they also made themselves far more vulnerable to the violent cyclical boom and bust cycles of the industrial sector?
It is the central tension of the pure play thesis. Industrial automation is heavily reliant on customer capex cycles. When borrowing costs are high and macro conditions tighten, companies delay factory upgrades and automation investments.
And aerospace used to smooth out those macroeconomic bumps.
Right. Without it, the cyclical exposure of the new Honeywell is entirely unhedged.
So if the industrial economy enters a prolonged downturn, this new, streamlined Honeywell could prove to be a much riskier play than the sprawling conglomerate it used to be. Make sure to follow the show for your daily earnings report coverage so you never miss the signal and the noise. Catch you next time.